Welcome, everyone. Thank you so much for joining us for this deep dive. If you appreciate us digging through these dense reports for you, please go ahead and hit that like button, subscribe, and of course, stay tuned for all our upcoming content. And a quick reminder, you can always support the channel by evaluating our membership options or by just showing your support with super thanks. We really do appreciate it. Okay, so today we are digging into ARM Holdings' Q2 results for their fiscal year 2026. This is for the quarter that ended September 30th, 2025. And our mission here is pretty clear, to figure out how this foundational IP company is really capitalizing on this huge shift to AI everywhere.
Exactly. We're going to break down the financials, the big strategic moves, and what this all means for the future.
And for you listening, ARM is, well, it's basically the invisible architecture inside everything, from the tiniest sensor in your watch to, the biggest AI data center.
Milliwatts to megawatts, as they say.
Right.
Yeah.
So looking at this Q2 report, which is just packed with stuff,
Yeah.
what was the first thing that jumped out at you?
It wasn't just one number. It was the consistency and, I guess, the strategic intent behind the numbers. This is their third straight quarter with over $1 billion in revenue. And that's great. It shows stability. But the real story is how they're using that strength. They're not just, riding a wave. They are executing a really precise plan to embed themselves deeper into cloud AI and the intelligent edge. This quarter is all about capturing future value.
Okay, let's unpack that, because the top-line numbers themselves are pretty incredible. They really suggest things are firing on all cylinders. Total revenue for the quarter was $1.135 billion.
Wow.
Yeah, that's up 34% year over year, and it was above the high end of their own guidance.
And when you break that revenue down, you see both of their kind of main engines working in tandem.
Let's start with the foundational one, royalty revenue. That's the money they get for every chip that ships with their design inside.
Right. And that hit a record, $620 million, up 21%. And what's important here is that it was broad-based growth.
Not just one thing.
No. It was smartphones, data center, automotive, IoT, all of them ticking up. That's a much healthier, less risky position to be in.
Okay, so if royalties are the steady engine, licensing revenue is.
Right.
Well, it's like the afterburner. That came in at $515 million, a 56% jump year over year.
And that tells you everything about the future, doesn't it?
Explain that.
Well, licensing revenue is basically companies paying ARM for the blueprint to their next generation technology. That huge spike means the biggest players are making these massive long-term bets on ARM's future roadmap, especially for custom AI chips.
But here's the part that seems like a contradiction. They're getting this incredible growth and these strong margins, while also setting a new record for R&D spending. How are they doing both?
That's the whole story right there. That's the strategic genius of it. They know they have to spend, and spend big, right now, to own the next generation of AI compute.
And they are. Non-GAAP R&D expense was up 45%, $466 million.
It's an aggressive investment. But what's so fascinating is the efficiency. Even with that huge spend, their non-GAAP operating margin actually went up to 41.1%.
And the cash flow. Talk about the cash flow.
Oh, the cash flow turnaround is just monumental. So operating cash flow was $567 million, which led to a free cash flow of $411 million.
And last year?
Last year, in the same period, they were at negative $65 million. So to go from burning cash to generating over $400 million in free cash, that's the clearest sign that those big licensing deals are paying off right now.
That's probably the single most compelling metric in the whole report. So for everyone who just wants that core financial snapshot, here it is. Revenue, $1.135 billion, up 34%. Non-GAAP net income, $417 million, up 32%. Non-GAAP EPS was 39 cents, which beat their guidance. Non-GAAP gross margin, an incredible 98.2%. And that operating margin we mentioned, 41.1%. And for Q3, they're guiding to revenue around $1.225 billion.
So they see the momentum continuing to build. They're not slowing down.
Not at all.
Okay, let's connect that R&D spending directly to where it's having the most impact. We have to start with the cloud and the data center.
Yeah, you have to. Because the shift happening there is, it's just cementing ARM as the foundation for the next wave of AI infrastructure. The milestone they hit this quarter is staggering.
Which is?
ARM Neoverse CPUs. They've now surpassed 1 billion cores deployed.
1 bill?
1 billion cores just for hyperscaler and AI workloads. That's critical mass. The game has changed.
So what does that mean in practical terms? It's a huge number, but what's the strategic impact?
It means ARM is fast becoming the, quote, new unit of compute in the AI data center. It's not just about taking a bit of market share anymore. They're setting a new baseline for efficiency that the incumbents now have to chase.
And they think their share of CPUs with the top hyperscalers could hit 50% this year.
Nearly 50%. I mean, that's a seismic shift, and it's all being driven by the insane power demands of generative AI. And we've got some amazing examples of why this is happening. It comes down to performance per watt, right? Which means lower operating costs.
Exactly. I mean, look at Google. They've moved over 30,000 apps, including YouTube and Gmail, to their own ARM-based Xeon chips.
And the performance gain.
Up to 65% better price performance, and they use up to 60% less energy. That is a massive, massive saving at scale.
And it's not just Google.
No, Microsoft is rolling out their Cobalt 100 chips to 29 regions. AWS is now running complex AI inference models natively on their Graviton 4 chips. The giants of the cloud have all made their choice.
And we can't ignore the NVIDIA partnership here. The report confirms strong orders through 2026 for the Grace Blackwell superchips.
That's a critical piece. They mentioned 5 new Stargate AI data center sites are being built, all anchored on ARM CPU architecture alongside NVIDIA's GPUs. So even at the absolute highest end of supercomputing, ARM is the foundational building block.
So that's the megawatt scale. But the other end of the spectrum, the intelligent edge, is where they really capture value. Which brings us to their compute subsystems strategy, or CSS.
Right.
Can you explain that in simple terms? How does CSS help them make more money per chip?
Think of it like this. Instead of just giving a car company a box of engine parts, ARM is now giving them a fully assembled, high-performance engine and transmission that's already been tested.
Got it. It's a pre-built platform.
Exactly. It's pre-integrated, pre-verified. It just dramatically cuts down the time to market and the risk for their customers. And the adoption numbers show it's working. 19 total CSS licenses now.
And the big one is that the top 4 Android phone vendors are now all shipping devices powered by CSS.
That's the standardization effect ticking in. It's an ecosystem lock-in, and it means those high-value designs immediately turn into high-volume royalties.
And the spearhead for this on the smartphone side is the new Lumex CSS platform. This is all about on-device AI.
Lumex is a beast. It's built to run these big, complex AI models right on your phone. It delivers up to 5 times faster AI performance on the CPU.
5 times.
5 times faster, and it's up to 3 times more energy efficient. That's how your phone can do things like real-time translation without sending your data to the cloud.
And we're already seeing it in the market.
Immediately.
Yeah.
Flagship phones from OPPO and Vivo launched with it in the last quarter of 2025. MediaTek is on board, so those higher royalty rates are already hitting the bottom line.
Beyond the phone, there were a couple of jaw-dropping examples of ARM in the sort of physical AI world.
The momentum there is just extraordinary. You have the Google Pixel 10 with their new Tensor G5 chip running the Gemini model 2.6 times faster. But the really wild one is Tesla.
The new AI5 chip.
Right. Their next-gen AI5 chip for cars and for their robots is also based on ARM, and it delivers up to 40 times.
40.
40 times faster AI performance than the chip it replaces. That's not an upgrade. That is a fundamental leap forward for real-time autonomy.
Incredible. Okay, let's shift to the ecosystem, their competitive moat, and then touch on some of the strategic moves and the risks. They claim over 22 million developers.
Which is more than 80% of the global total. And it's probably their strongest intangible asset. It creates this self-reinforcing flywheel.
How so?
Well, developers optimize their code for ARM first. That software advantage drives more hardware adoption, which then attracts even more developers. To keep it spinning, they're constantly releasing new tools like Kleidi AI, which can make AI frameworks like PyTorch run up to 2.5 times faster.
Okay, now for some of the financial housekeeping, they booked a gain from a sale, but also announced a new acquisition.
Right. They finalized the sale of their Artisan IP business to Cadence. That brought in a nice $131 million pre-tax gain. So they're trimming non-core assets.
And what are they buying?
They're buying a company called Dream Big Semiconductor for $265 million in cash. So you can see the strategy. Sell off the non-essential and use the cash to acquire capabilities that support their core AI roadmap.
Makes sense. Finally, let's talk about the headwinds, the risks. Geopolitics is always front and center.
It's the primary source of uncertainty, for sure. The report goes into the complexity around U.S. export controls. The U.S. government is still laser-focused on restricting the most advanced tech, specifically chips that use things like GFET transistors or HBM from getting to certain regions.
And that regulatory churn is a constant headache.
A huge headache. And the litigation with Qualcomm isn't going away either. There's an appeal on one case, and a whole new action is set for trial in mid-2026. It's a distraction and a resource drain.
And one last risk you can actually see on their income statement, the reliance on ARM China.
Yeah, that dependency is still very pronounced. Revenue from related parties, which is mostly ARM China, was up 120% year over year.
So while it's great for accessing that market,
It also highlights a significant dependency that they have to navigate very carefully, especially with the geopolitical climate we just talked about.
okay, so let's synthesize all of this. If you had to boil it down to the 5 most important takeaways from this quarter, what are they?
Okay, number one, just sheer financial muscle. A $3 billion quarter and that incredible turnaround in free cash flow. That's the foundation. Two, undeniable dominance in cloud AI. That 1 billion Neoverse core milestone says it all. The hyperscalers have made their choice. Three, their high-value CSS strategy is working. It's driving higher royalties per chip and creating that ecosystem lock-in. Four, aggressive but very smart. R&D investment. They are spending big to build the future of AI, but they're doing it without hurting current profitability. And five, that 22 million developer moat is just getting wider and deeper, and it's probably the hardest thing for any competitor to replicate.
It's a full stack, end-to-end unification strategy, isn't it? They're aiming to be the one software architecture that runs from the smallest wearable all the way to a gigawatt-scale data center. You see it with partners like Meta, who use ARM for literally everything. So the final thought for you to chew on is this. If ARM's strategy of efficiency and unification really is setting the new standard for an AI everywhere world, which of the traditional chip giants, the ones built on legacy architectures, is the most vulnerable? Who stands to lose the most as this shift accelerates? Thank you so much for joining us for this deep dive. If this gave you a clearer view, please click that like button, share the video, and subscribe so you don't miss our next analysis. And remember, you can always evaluate our membership options to help us keep making these deep dives, or show your support with super thanks right below the video. We will catch you on the next one.